Hi, this is Mike Lembeck with Remax Commercial, bringing you this week's Let's Talk About It. The apartment transactions at a virtual standstill is our first article we're going to review. And what we're seeing is the market for apartment transaction has come to a virtual standstill, according to a recent report from National Multifamily Housing Council, as buyers seek a higher rate of return that sellers are unwilling to accommodate via lower prices. So we're looking for a balance in the market between buyers and sellers, and it's still looking like sellers are feeling that they're in charge with as far as the values go and pricing, and buyers are not willing to bring their offers up to a point of what the sellers are asking. So this could run into next year somewhat, as far as this normalizing of the market. The physical apartment market is also starting to normalize after 6 consecutive quarters of tightening conditions. So, again, we're seeing tightening conditions of funding and also for loans to be able to provide money to move transactions through the process of escrow. It's not happening yet as far as the loosening of the lending standards that need to be done with the higher rates. We're still seeing the same type of lending standards that we had back when rates were lower. So I don't think that's going to change at all anytime here soon. The sales volume has declined for the fourth consecutive quarter. The vast majority of respondents, that's 89%, reported lower sales volumes, while only 1% reported sales volumes to be higher than 3 months ago. So we've seen a significant amount of lower sales volume. The debt financing index continued to indicate deteriorating conditions for debt financing. Again, financing is going to be a little bit harder to come by with the higher interest rates and also the tightening in the lending market. The next article we have is Mortgage and Interest Rate Shock. Never in history have rates risen so fast. They haven't risen this fast in such a short amount of time at all ever in the past. So there's been that extreme 0.75% basis point increase over the last 3-4 months that we've seen having a significant impact in the market. And what do these higher interest rates mean for unemployment? As housing goes, so goes the economy. The National Association of Home Builders sentiment is the best gauge of future unemployment. It leads 9 months, so the historical relationship points to a higher than 7% unemployment rate in 9 months from now. So we're talking about a pretty significant, almost doubling of the current unemployment rate in 9 months. So this is a lagging indicator of, or a lagging stat that's going to move as we move forward. It's a good thing to keep an eye on this, and if this starts to increase like they're anticipating, we're looking for bigger problems than we already have. And also, what does this mean for housing? The move in the 30-year mortgage yield is simply unprecedented. The current average level, around 7%, implies a 20% drawdown in residential prices over the next 9 to 12 months on historical correlations. The correlation is very strong. So we're looking at a 20% drop in prices with the interest rates going to 7%. The next article we have is buckle up for a brutal freefall in home prices, and U.S. housing is in a massive bubble, experts say. Here's how bad Jeremy Siegel, Paul Krugman, and 5 others think it will get. These are 7 economists or professors of finance that are talking about the economy here. This Jeremy Siegel is a professor of finance, and I expect housing prices to fall 10 to 15%, and housing prices are accelerating on the downside. So right there is one. The Mark Zandi, the chief economist at Moody's Analytics, says buckle in, assuming rates remain near the current 6.5% and the economy skirts recession, then national home prices will fall almost 10% peak to trough. And there's going to be a coast-to-coast downturn in the housing market. It's going to be brutal. No part of the market is immune. So we're looking at a coast to coast, all California to New York, and southern United States all the way up to the Great Lakes and Dakotas. Everywhere we're going to see a downturn in the market. David Rosenberg, he's a veteran economist. We have a massive housing bubble right now. Most of the household balance sheets in residential real estate, or most of the household balance sheets is residential real estate, and it is equities. The economist pointed to the Fed's tightening efforts to bring inflation down from recent rates of 8 to 9% to its target at 2%. They want the stock market to go down. They want home prices to go down. Why? Because there's not a snowball's chance in hell they're going to get their 2% holy grail consumer inflation without there being a period now of asset deflation. It's 100% necessary. So we're looking at quite a while before we see this inflation rate drop down to the 2% that the Fed is looking for. Paul Krugman, again, Nobel Prize winning economist. The veteran economist agrees that there's a severe downturn coming, but he expects it will be a while before higher rates really hit home prices and demand. So he's looking at another few months before we see this really hit the home prices and the demand with these higher rates. So we've already seen a big slowdown. We're looking at potentially an even more dramatic slowdown. And the wider economic effects of the coming housing slump are still many months away. So he's predicting things again to get worse. Ian Shepherdson, chief economist at Pantheon Macroeconomics, we expect a drop of 15 to 20% over the next year in order to restore the pre-COVID price-to-income ratio. And then Dan Peebles, a real estate developer. I think the housing market is on its way into a recession. We're going to see price declines. Price declines have already begun to take place. I look at this as though we have this freight train out of control, speeding up with low interest rates, and no one looked to start slowing it down or stepping on the brakes. Now all of a sudden it's going to come crashing into the station. So we've got a runaway train of this economy, low interest rates, and now all backing off of everything with the higher interest rates. It's just going to be a big mess coming crashing into the station, as he says. And then Chen Zhao, economics research lead at real estate brokerage Redfin, says with inflation still rampant, the Federal Reserve will likely continue hiking interest rates. That means we may not see high mortgage rates, the primary killer of housing demand, decline until early to mid 2023. So we're looking at the first quarter roughly of high mortgage rates as best case scenario all the way into potentially early or mid 2023. Okay, that wraps it up for this week's Let's Talk About It in the SoCal Multifamily Sales Pulse. If you have any questions on anything as far as the economy or the market goes, any as far as values, what they're doing in this market in a certain specific area throughout Southern California, go ahead and feel free to give me a call or send me an email, and I'll give you a response as accurate as I can with the information available. If you're looking at potentially selling your property or even buying some an additional properties, I'd love to talk to you about that also, give you a market analysis on your current assets, and then also give you an idea if you're a buyer at what available inventory is out there. And as far as doing a 1031 exchange to reposition your equity that you currently have in your properties, I'd love to talk to you about that also. Is potentially doing that into sometime next year if it's not the right time now.